Hello, everyone. Today on the final bar, my guest is Joe Duarte from JoeDuarteInTheMoneyOptions.com. I'm going to talk just a little bit about covered calls. Interesting discussion on a day like today. The S&P's been hanging up around the 3,600 level. Felt like that through most of the day, but really accelerated to the downside with some distribution, not really caused by anything in particular that I've seen just yet, but certainly just a downturn that was overdue, perhaps. We've talked about the extremes in sentiment. We're going to look at the charts and what the short-term distribution means relative to the long-term trends, what we should be concerned with, what we should be looking at. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. This is Dave Keller here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together, try to make sense of the trends, the momentum, the sentiment, all of those building blocks of investor behavior, and try to anticipate where trends are headed. As I mentioned in the introduction, certainly some distribution going into the close today and accelerating to the downside. So, you have a number of really interesting themes in here. Probably most notably, energy has been the number one sector pretty consistently here for the last week or two, and now down at the on the bottom of the returns list. Overall, I mean, I think we're going to find as we look at the charts together, the trends are in pretty decent pretty decent shape. However, the chart of the S&P just continues to drive home the importance of that 3,600 level that we keep not getting confirmation above. So we'll look at all those charts and more. I did want to give you a quick heads up on the schedule. We have Joe Duarte joining the show today. I'm very excited to get his take on a couple key things. Tomorrow, we have Mark Young from WallStreetSentiment.com. Coming up next week on Tuesday, the 24th, T.G. Watkins from Simpler Trading. And then just so you know, we're going to take a couple days off there for the Thanksgiving holiday. So we'll be off next Wednesday, Thursday, Friday, and we'll catch up with you again the Monday after the Thanksgiving holiday. As a quick heads up also, I'll be speaking at the Money Show Virtual Expo this week. It's actually coming up tomorrow on Thursday, the 19th. I'll be giving a presentation at 2:40 p.m. Eastern called 7 Bull Market Mistakes and How to Avoid Them. Hopefully the bull market stays in place before tomorrow at 2:40 Eastern. Certainly seems to be my expectation, but we'll talk through some of the things to keep in mind as the market's at or near all-time highs. Getting to the review, you can see on the market recap here, the S&P chart, you can see it accelerating to the downside, really just an exponential drop here, sort of bounced around, chopped around, and felt like it was going to recover a bit just after 3 p.m., but really sold off into the close. That pushes the S&P down over 1% for the day, still not anywhere near the verb crash or anything like that. It's more of a distribution, kind of profit-taking sort of day, which is totally fair. Looking at some other themes, mid caps and small caps down a little more, but all of them pretty much about the same, 1.33%. NASDAQ 100, the best of that group, down only 0.7%. The VIX back a little bit higher, but nothing too crazy. Looking at the other markets here, bonds finished really more toward the higher point of the day, really came on strong in the afternoon. The dollar flat, although it was down for much of the day. UUP sort of finished flat for the day, and 10-year yields back around 88 basis points. In commodities, you see gold and silver coming off. The commodity complex as a whole essentially flat because oil prices were up a little bit, even though energy was down pretty good. So the fact that energy is down so much, with oil really not down, tells me that this is more distribution, taking profits on a nice bounce in some of these names that have worked pretty well. Interesting to see the top sector out of the 11 today is the industrial sector. If you've talked about that long-term evolution in some of the charts like Honeywell, like Caterpillar, railroads, overall in these nice sort of slow and steady uptrends, not super, exciting, but just, nice and stable, consistent performance. So interesting, the relative strength is going to hold up just fine on a day that they're down not nearly as much as the overall market. Consumer discretionary as well, outperforming as well as materials, financials on the downside, energy leading the way down, followed by utilities, followed by healthcare. Let's go to the chart of the S&P and just see how today's sell-off sort of fits into the big picture. So when you look at that one day, 2-day chart, certainly feels like this was a dramatic sell-off. I mean, when you look, we're coming off of pretty extreme high levels. We just made a new 52-week closing high 2 days ago. So let's not get too crazy about a mass distribution, but it certainly indicates some profit taking after a nice couple weeks coming off of that low in late October. As we've talked about, we've talked about this range 3,200 to 3,600. I keep looking for signals that range has been broken. As we've talked about, once we get a confirmed break above 3,600, I will give you the all clear signal suggesting a higher probability for much further highs. We had that dramatic close higher on Monday, but since then we've had a series of lower closes. So until you kind of close above that level, we haven't had the follow through. We've had that initial push higher, but we're sort of giving some of those gains back, actually going back to the range from last week. So overall, while today is not huge negative, and again, you remain above the swing lows from last week, and you're still just even in a tactical time frame in a little short-term uptrend, certainly keep getting signals like this telling me that the 3,600 level is a pretty significant one, a pretty valid one, and a break above there even more and more meaningful. Every time we test it and fail, that means if and when we finally do break above it, that's a pretty meaningful break to the upside. Let's look at some of the other charts in our Mindful Investor Live chart list. What sort of themes we can tease out here. We looked at the daily chart of the S&P. We talked about this breadth chart yesterday. I just wrote an article for cmmarket.com earlier today about this cumulative breadth reading. And when you look at the cumulative advanced decline lines, essentially looking at where each of these breadth measures, what they're doing relative to the overall market. It's a measure of participation. So the S&P chart does one thing. What do these individual breadth lines, which essentially tell you the names that make up those indexes, what are those doing? And we have seen the upside breakout from the S&P advanced decline line, from the mid-cap advanced decline line. Just this week, we finally had breakouts from the small-cap advanced decline line and the NYSE common stock only AD line. So all four of those sort of in the positive territory. These aren't updated yet for today, so it's going to give back a little bit of those gains, but overall still still in a pretty positive light, which tells you overall that the trend has been remarkably positive, right? I mean, and that's fair. Looking at our market trend model, looking at the breadth conditions, they all sort of confirm the fact that we're at near all-time highs, which is impressive. In terms of things that suggest we're overextended, a couple things that come to mind. Some breadth readings certainly getting to the upper end of their range. And then sentiment's a whole other beast that we've talked about as well. This is an interesting chart. This is looking at the percent of stocks above their 200-day moving average. We've now eclipsed the high that we had in January of 2020. That was the highest it's been in many years. We actually have eclipsed those high. We're almost at 90% stocks above their 200-day. So 9 out of 10 stocks at this point in the S&P above their 200-day moving average. It's actually pretty rare to have it be that extremely high. What's interesting about it, though, is if we back this chart back, I don't know, 18 years or so. This is going back to like 2002, the 2003 low. Look at when it actually gets up to this level. So that blue line is right around 85%. So if you get above there, you can see we're currently around 89%. It does not happen often is the point. And coming off of extreme lows, you certainly had it. So coming out of the low in March of 03, you got about 90% plus of stocks above their 200-day here at the beginning of 2004. We had a brief pullback, but that was obviously the beginning of a much further upswing. In 2009, after the low there, you had an acceleration to the upside coming from essentially 0% of stocks above their 200-day to almost 100% of stocks above their 200-day. That was here. So again, before a multi-year bull market phase. But what's more interesting to me is how this relates to other more extended periods. And I think what's really interesting to me is actually looking a little bit, I mean, obviously much different price performance, but looking a little bit like 2013, where you finally broke above and you had about 95% of stocks above their 200-day. And that was when the S&P made essentially new highs just before it made new all-time highs, going above the 07 high, and obviously before a couple years of pretty slow and steady gains continuing to the upside. So, what's interesting is we're at those extreme levels, and while you initially would think, boy, that's an upside extreme, that's probably bearish. I have not run the numbers on this. I bet, and we should talk to someone like Ryan Dietrich, who tends to run good long-term statistics on this at LPL Financial, or Jason Gefford at Sentiment Trader, perhaps. But looking at this, I mean, just visually, you can see a lot of similarities to, periods just before extended bull market phases, which could mean, I mean, this could be the beginning of indication going into next year that there's much further upside. I think the thing to remember though is between where we're at right now and where we could be much higher, there are career busting downswings that happen along the way. So I think the fact that we've gone so high so quickly coming out of the zero level is pretty unusual. It looks a lot like coming out of the '09 low in terms of the acceleration of this rating. And again, there's some choppy stretches there where we gave back a good amount of the gains before we resumed to the upside. That was a deep dive into the breadth measures there, but I thought it was an interesting one to look at. Finally, I just want to point out, with a lot of these sectors, you can see like consumer discretionary versus consumer staples, essentially flat, right? Showing you on a cap weighted basis, which is a heavyweight in Amazon, obviously in the numerator of that ratio, but it's essentially saying the two sectors are in line. But if you look at the equal weighted version, it's not just Amazon doing well. There's, on average, the average consumer discretionary stock is doing better than the average consumer staple stock. And if I had a line that would tell me more of a true measure of offense versus defense within the consumer space, it would be this bottom panel, and it's essentially still in a pretty decent uptrend. So again, today was certainly distribution. I think you'll see some charts where the most recent day has come off a bit, but overall, still in a pretty strong up current. We need to take a quick break. Back with my guest, Joe Duarte. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We love to hear from you, particularly questions you're running into as you are analyzing your own charts. A couple ways to get your questions to us. Number one, the Final Bar at StockCharts.com is our email. On Twitter, just tag us in a comment at FinalBarSCTV, or on our YouTube channel, just put a comment below the video you're watching. We will gather all of those questions. Look forward to answering one of your questions in our next mailbag segment, which will be the end of this week. I want to welcome on my guest, Joe Duarte from JoeDuarteInTheMoneyOptions.com. Joe's been contributing content to StockCharts.com for much of 2020. After we had a really good conversation at one of the Money Show conferences earlier this year, Joe, which feels like a lifetime ago, actually, right?
Yeah, it does, doesn't it?
A lot has happened, but we appreciate so much. You've done such a great work with the stuff you've been writing, also hosting your Daily Five. And as I mentioned to you, we added options trading onto our StockCharts ACP platform. So we're getting more and more questions related to that. So look forward to hearing your take on the market, and then particularly looking at covered calls. So take it away.
Well, first thing we want to do is just talk about the advanced decline line. You gave great detail on it, but this is a chart from early this morning. If you were to update it, obviously you'd see that it rolled over a little bit. I don't have much to say about it other than I think that the last thing you said, that we could be on the verge of a long-term steady climb. I think that's probably the take-home message until proven otherwise, because of one factor, that's the Federal Reserve. As long as they keep putting $100 billion or more into the bond market every month, there's not a whole lot of alternative, and so people are just going to keep on buying stocks.
Fair enough, and I love that way that you phrase it. Until proven otherwise, the trend is positive, right? That's a fair take.
Absolutely.
Chart number 2 is looking at Gilead. Obviously, biotech stocks have been a lot of attention on these, given what's going on in the world. Walk us through this example.
So what I want to do with this is set up the call writing strategy. The take-home message from this chart is that Gilead has the potential to form very long-term basis. And that's really the key to picking good stocks that are good for selling calls on. So really just focus on that 2019 period where you see that long, choppy base. That's the perfect stock to go ahead and write calls on. And I'm going to be talking about that in some detail in the next couple of minutes when we're ready.
Yeah, let's do it.
Okay, so if we go to the next slide, we have the keys to the buy right strategies. Okay, so this is a pretty good summary of a buy right or covered call strategy. And so what a lot of people don't get about options is that the more reliable way to make money in options is to sell options. So when you do a buy right strategy, you're basically buying a stock and then selling an option. Of course, you do that simultaneously. So the first step is you buy a stock that has a base. And the reason for that is because as long as it's in the base, you're going to collect that premium for selling that stock, and you don't have to worry about being assigned or having to sell the stock at a loss later or at a much lower profit. So the key here is to sell volatility. And so you have to look at the historical volatility, which for this example that I'm talking about with Gilead at the moment is 18. And the implied volatility is 30. So that's a nice example. You have a stock with a base, and you have a stock with implied volatility that is historically high. So that's two things. So the next thing is you want to buy or you want to sell a slightly out of the money strike price call. And so in this case, I chose the December 31st, 2020 63 call, and basically that gives you about a $3 margin before the stock gets in the money and you have to start worrying about getting assigned. The other thing is December 31st is 43 days from today, so you want to sell options at 45 days or less to expiration. That way you don't get caught up in too much of the volatility as the option price will start to drop and the odds of being assigned decrease. Now, in this case, and your trading software will tell you all this, so your maximum gain for this trade would be $302, and your break even is $59.98. So if Gilead drops too much below $59.98, you might want to go ahead and close out the trade and try again later. But as long as it stays above that break even or above or in between the $60 and $63 area, you're probably going to keep some of that premium. And the other thing is, if the stock is below the strike price at expiration, then you probably got some money in your pocket, and you go ahead and roll the trade over to the next 45-day period. However, if the option is in the money, which means that it's above $63, you have to look at the odds of being assigned and losing some money. So that's a pretty quick overall view of how to do this. And of course, on my website, I talk about it in more detail. And of course, in my book, Trading Options for Dummies, you get the whole idea. The last thing I want to say is that in a market like we are right now, you have great opportunities to use this strategy. In a market that is trending significantly higher, you're probably better off buying call options instead of selling options.
Fascinating, Joe. And this, I tell you what, I mean, I feel like I have so much more I would want to ask you. We're out of time, but I love this example. I'd encourage people to check out your book, Trading Options for Dummies, which is on the StockCharts store. And also, I know you've done such a great job, incorporating some of this content in your work, and I look forward to getting more of this sort of insights to our users through StockCharts TV. Joe Duarte, thanks so much for coming on the show. Thanks for walking through this example with us.
Thanks, Dave.
That's Joe Duarte from JoeDuarteInTheMoneyOptions.com. And as I mentioned, I met Joe earlier this year, if not the end of last year. It's a blur now. This is pre-coronavirus, PC. And had such a great conversation with Joe. He's just a thoughtful, calm trader. And what's fascinating to me, my column is called The Mindful Investor. And I remember thinking as I'm talking to Joe, like, someone who's just such a laid back way of looking at the options market, which, for me, you think about volatility, you think about all this potential movement. I think it's well worth checking out some of Joe's work and trying to make sense of some of these option strategies that could certainly make sense in the current environment. We need to get on to our next segment, though, which is called Today's Chart List. We love to do regularly is just review the chart list feature on StockCharts.com, highlight some of the ways that you can break down the universe in different ways. So what I'm going to do is actually share with you one of the chart lists that I use to track global ETFs. If you'll notice on my dashboard, right? Your dashboard, if you click on the Your Dashboard button, the top parts of these are going to look pretty similar, but some of these objects are actually customizable. And if you don't have some of the ones that I do, a couple things you can do. Number one, click on the little gear icon there and put things like the additional data panel, scans, and alerts. That'll add some of the capabilities that I do. I have the commentary one turned off only because the video will come up while we're recording this. But if I was a StockCharts member using this for my own benefit, I definitely have it on because you can watch StockCharts TV right through your dashboard. But as you get down a little bit, you have the ability to show two different chart lists. So for me, I have these same two up all the time. The one is looking at global equity ETFs. The second is looking at the Dow industry groups. And again, I refer to these regularly, and I want to focus on this one on the left just to show you what we're doing. So at the bottom below there, you're going to have a section called Your Chart List. We're going to go down to this one called Global Equity ETFs. And if you just click on it, it's going to go to the summary view, which shows you this list of things. So I have this numbered, it's sorted numerically. So I have them starting with the regions. So the US, global developed markets, global emerging markets, frontier markets. And then it's just going through developed Europe and then Asia, some Latin America kind of mixed in there. And it's just sort of the, key 20 or so, 15 to 20 global ETFs. A lot of these are the are things like the EWP, the EWJ. These are the iShares MSCI ETFs. And again, you may have a better universe that you work with. These are just the ones that I found to be pretty meaningful. So what I like to do is a couple different things. Number one, I like to look here and sort them by scooter ranking. So if we click on that column, we're going to sort the strongest trends from top to bottom. And again, our scooter rankings, we've done, plenty of discussion on this over time, but essentially, weights the long-term, medium-term, short-term trends, and the higher the number, the higher the percentile ranking based on the historical trends, essentially. And it's more of a long-term reflection of trend characteristics. So what you can see is out of this 20 or so, 25 different ETFs, South Korea EWI is the top performer. You bring up the chart and you can see why that's the case. And I'm not showing the scooter value on here, but you can see that the price has made new highs, new lows pretty consistently from late March. You can see that the peak in January was actually eclipsed back here in August. We had a nice pullback there in September, a nice higher low there in late October. And now we're zooming to the upside. You can see the relative strength is actually quite impressive, had underperformed going into the March low, but since then, South Korea has actually been a pretty decent strong relative performer. What's interesting about this chart right now is that we're overbought. In the last couple times we've been overbought here in August, which was a bit of a pullback here in June, bit of a pullback. So again, may not be surprised to see a bit of a pullback here, but you can see on some of these pullbacks, we've remained above for the most part an ascending 50-day moving average. And that's what I would expect on any sort of a pullback on a chart like that. Mexico, number two, and what I love about doing this sort of chart list, Mexico is not a market I look at very heavily. When I used to travel down there, I would look at there and look at some of the key larger names and break them down, but I don't pay as much attention to them now. But what's great about sorting a list of ETFs by scooter rankings, you immediately find the best trends, whether or not you're familiar with the stories, and maybe these are some of the charts you want to dig into a little further. When I'm looking at the chart of Mexico, you can see the peak in June. You can see the peak was revisited there in October. We pulled back there and then finally broke above there. We've now gapped above that 36 level and maybe 38 if I'm thinking of this and thinking of potential for further upside. 38 is a really logical pullback level on a chart like this. You can see similar to the first chart, South Korea, you can see it's overbought as well. But I like how the relative performance started to really improve. It's made a new 6 month, relative high again this week. So some of these ETFs are actually setting up in much better conditions than you may be familiar with. Now there are going to be other ones that you probably are more familiar with. India is a market I look at a little more regularly, so the patterns are a little more familiar to me. But what you'll find on a lot of these is while the S&P has hit resistance and been unable to eclipse it, you'll find that a lot of these global ETFs have actually already been able to do so. India actually broke higher a couple of weeks ago, and really the early October took us well above the late August peaks on INDA, which is one of the more liquid India ETFs. We then broke above it and retested the breakout level here last week, and now have continued up to continued further to the upside. So again, a lot of room there for a pullback, not yet overbought, similar to what we saw with some of those other, with some of the first couple charts we looked at. You'll see China, others are related in here. We don't have time to go through all of these, but it's also worth looking at the worst performer. So out of that list, Switzerland is the worst scoring stock out of all these. Now, if you think about those first couple charts, which were in pretty consistent uptrends of higher highs and higher lows, look at how the Swiss chart is a little different. Now you've rallied back up to the September high. You've not really been able to break above it. This looks a little more like the chart of the S&P. What's interesting with the chart of the EWL, which is the Switzerland ETF, is you can see that we've actually remained in bearish territory according to the RSI. So bearish territory is sort of, you become oversold. You never really get above 60 on a rally. And you can see that that's pretty much been the case from sort of August. You've sort of settled back down into this bearish range, ranging from oversold on a downswing to around 60 on an upswing. And really you have clear resistance right here around 43. If and when it breaks above there, that would be pretty encouraging. If the relative strength starts to improve, that would be a little more encouraging. But at this point, not the best chart. So again, what I like about this is being able to sort the list very quickly. The last thing I'll just mention to you very briefly before we wrap this segment is to point out the candle glance view. You know from watching the show, hopefully that this is a view that I like to use pretty regularly, because it's a great way to, essentially it's the version of printing out a bunch of charts, throwing on a huge table and seeing what patterns are related to which. And what I usually do with this is look across some of these patterns, see where charts are relative to their 50 and 200-day moving averages, see which ones are recently breaking new highs, see which ones are at clear support or resistance levels, any breakouts, breakdowns, basing patterns, jotting down the tickers, and then digging in a little further as we go on. And you'll find charts like Taiwan that just jump off the page, having this acceleration off the 50-day moving average. Maybe I want to dig into that a little more and pay attention to it. So overall, that was the chart list of the day, looking at global ETFs. If you're interested in this one, just shoot me an email, thefinalbar@stockcharts.com. I'm happy to send you the chart list right to your login. You're welcome to take it and do what you want. Just mention you want 1,300, the global equity ETFs chart list, and you're welcome to it. We need to wrap this show, folks. Go to the 3 and 3 charts, 3 minutes. Here we go. I went in some pretty heavy detail earlier about this chart, which was looking at the percent of stocks above the 200-day. My initial reaction when I see such a spike, and I see almost 90% of the S&P above the 200 days, to think that feels overextended. It feels like too many stocks on one side of it. If you look there from 2009 to 2013, you had a series of periods where that sort of thing happened, where you had that many stocks above their 200 days. So while you initially might think of that as a topping pattern, in the short term, it certainly could indicate that the market is due for a bit of a breather. Overall, that sort of signal is more characteristic of bull market phases than bear market phases. It's actually more of a long-term bullish reading, I think, than anything. Chart number 2 is the relative performance of semiconductors. We didn't talk too much about semis in this show, but and we've really been talking about other sectors so much. I haven't dug into technology in a little while, but the SMH continues to make new relative highs. Not quite doing a new relative high today because you had the spike last Monday, but overall just in a really strong uptrend. And the relative strength of semiconductors holding up, I would argue, is a key part of an overall structural bullish environment. If that starts to fail, that tells you that things are starting to get a little uncomfortable with a key group that's central to so much of what we're doing now. Finally, I want to finish just with an example. I love to just throw a random ticker out there, something that's in a pretty decent shape. Dow Holdings fits the bill right now, some of them in the materials sector, but I like the fact that it has had essentially, if you take a step back, just this nice consistent uptrend, these bases that resolve to the upside. You have this base in June, July, August, we broke to new swing highs, retested that level from above there a couple times with a new basing pattern here in September. Now we've broken up there. You have clear support right at 50, and the ascending 50-day moving average is right around there. So I think on any sort of pullback, you have a decent objective, and it lines up with the highs that you had back in October. What I like is this is a stock that was up 1.5% on a day when most stocks were down, and that's the sort of opportunity that I like to capitalize on. Stocks holding up when most things are kind of rotating lower. Folks, that is our show for today. Thank you so much for joining us. Special thank you to Joe Duarte from Joe Duarte InTheMoneyOptions.com, talking us through a covered call example. We have our survey running right now on our StockCharts TV page. Would you do me a favor? Go fill it out right now, StockCharts.com/TV. Give us some feedback on the channel, on the shows, on the hosts, whatever we can do better. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.